Welcome back to our course on FinTech risk management. This is part 2 of a two-part video related to strategy and technology for implementing corporate governance. In our first video, we talked about some of the risks and challenges and business risks of FinTech, and we talked about examples of new regulations, the nature of FinTech creating risk. We talked about open banking API as an example of new regulations, and there are other regulations. We've talked a little bit about cryptocurrencies and are they securities or not as coming into play, a little bit of changing risks to financial institutions and politics. These are all sources of risk. Now, let's talk about strategy and how do we deal with these risks, because we have a lot of business risk in FinTech. So the question is, if you're facing this kind of business risk, what do you do about it? Well, first, one of the first strategies is to recognize that risk is much greater than you thought it was. If you look, for example, at Deutsche Bank and their risk model, they have looked at risk in their institution and sources of risk, and they've said that most of their risk comes from credit and market. There's a little bit of risk from operations. I think they're underestimating that, but let's put that aside. Business risk is considered to be very, very low. We're going to be a bank. We'll still be a bank. We'll be around a long time. Maybe it's higher than they think, particularly as they get more into FinTech areas. Credit risk may go down. They may have less capital deployed. They may be less capital intensive, less of a financial institution, more of a tech firm. Their market risk may go down. Their operational risk may go up, but their business risk could go up a lot. If you look at this for a FinTech firm, it would be much higher. So recognize that risk is much higher than you thought it was, and it's different than risk of traditional financial institutions. Business risk is high. Now, what do we do with firms that are facing high business risk? How do we manage that high business risk in other industries? Well, one of the things that companies have been able to do in successfully managing business risk is to plan ahead for risk and uncertainty. An example of that is something called scenario planning. Scenario planning is an approach to planning for uncertainty. Shell Oil made scenario planning popular or better known in the 1970s. I know that's a long time ago, but it's not that long when you think about strategies and parallels and examples. When they were looking at risk in oil prices and oil markets, and they said, oil prices have gone down, 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 down forever, and they're relatively stable, but there's some indications that things may go awry. And when we have wars and rumors of wars or deregulation or new markets, we can say, wow, things could be much different than we think they are. Now, what we do know about finance markets is that people often underestimate the unlikely. They underestimate the impact and they underestimate the cost, or the likelihood and the cost. So they think these long tail things are not likely to happen. Well, the nature of business risk as well as operation risk is that long tails are more likely than not. We are more likely to face high uncertainty, high unknown. And when we have that kind of skewedness or that kind of kurtosis that we talked about in an earlier video, a strategy for dealing with high uncertainty is to plan for highly uncertain futures. And so we look at scenario planning and we say, I don't know what the future is going to be. I don't know what's going to happen with the economy, with interest rates, with deregulations, with new competitors, with new technologies. So let's lay out some possible futures that are very provocative. Now, when I was dealing as a management consultant working with McKinsey and clients in deregulation of electric utilities and deregulation of telecommunications, we looked at possible futures and we said, we don't know what the regulatory environment is going to be, but what if this happens? What are the implications for our firm? And so look to the future and ask what's possible and how much could things change on certain dimensions. We don't know, but what the first step is to say there are things we don't know, and let's understand what we don't understand. And then let's lay out some scenarios that may help us. That is one strategy. Another strategy for dealing with risk and uncertainty is to have some reserves. Well, that's a good thing, and that's typically the way regulators like you to deal with uncertainty. But I think that's probably the least useful strategy for dealing with this. A better strategy is often to have a portfolio. If you look at venture capital and you say, we don't know which firms are going to be good, which firms are going to be bad, there's a lot of risk and uncertainty, so what do? Let's have a wide portfolio, because we have no idea who's going to be the huge winner, who's going to be the new Facebook. We just don't know. We can't predict. And so let's have 20 investments. And so how do you do that as a bank or an insurance company? You place bets. You have partners. You make investments in small amounts in a lot of different companies. And you say, you know what? I don't know who the winners or losers are going to be in this new fintech world, but I could be a venture capital firm to help fund some possible winners, and I'll probably lose money on a lot of these. That's okay. I'm betting on the possibilities of technology, business innovation, market innovations, deregulations, and I'm saying sometimes I might win. In addition to a portfolio approach of investing in other companies, I may also use a sandbox approach to say, let's explore, let's get permission from regulators to set up our own subsidiaries, our own startups, our own entrepreneurial activities, and let's directly invest in exploring the unknown, the unthinkable, and sometimes let's invest in competing with ourselves. For example, in London, one of the most popular banks is a subsidiary of HSBC that does direct banking. And they don't have any branches. They don't have any clerks. They don't have any offices. They're all online. And they're very, very popular. Their customers are very different from typical HSBC customers. And that's okay. They're competing with themselves. That's not a bad thing. When the world is filled with uncertainty and risk, competing with yourself may be the smartest thing you can do. Because if you don't obsolete yourself, someone else will do it for you. And so you need to think through strategies to compete with yourself, invest in startups, join with partners, develop alliances, partners, relationships. These can be part of a strategy for competing. Buying technology. Japanese firms in high-tech industries have for a long time been quite willing to buy technology. U.S. firms starting to get into that. Chinese firms in some cases getting criticized for doing too much of buying technology, particularly from U.S. firms. But you don't have to invent it all. You can buy it. These are all different strategies. So scenarios to help you in planning. Portfolios to help you with investing. Relationships, partnerships, alliances, virtual alliances to help you in rolling out new products and new ideas. Sandboxes to help you with internal development. These are all different strategies to think through. The most important strategy, though, is to start off by saying there is more that we don't know than we do know. The risk is high, the uncertainty is high, so everything you thought you knew about being a banker or being an insurance company, put it aside and say, I think there's a lot that we don't know and that we could learn, and let's keep an open mind. Not the whole institution, but some parts of it need to be thinking more broadly and outside the box, that the world may not be the same as it used to be. Thank you.